Hello. Thanks so much for joining us for this discussion with Dr. Darien Shanske about corporate taxation and specifically Nebraska's conformity to a federal provision taxing some foreign held corporate income. Dr. Shanske is a professor at UC Davis School of Law who has expertise in tax law. He recently joined us for a conversation following the prioritization and advancement of LB 432 by the Revenue Committee. LB 432 is an omnibus bill that, among other things, would decouple the state from a base broadening provision of the Tax Cut and Jobs Act of 2017, referred to as GILTI. Before we start the interview segment, we want to note that this interview was recorded prior to our knowledge of an amendment that limited the scope of the proposed decoupling, so there are references to the taxation of foreign repatriated income that are no longer relevant to the current version of the bill. We hope you will find this discussion with Dr. Shanske as informative as we did. Could you start by giving us a brief overview of what global intangible low tax income, or GILTI, is?
Sure. So GILTI, global intangible low tax income, is a formula meant to ferret out income that was really earned in another country. So in particular, income that was earned in the United States, but that a big multinational corporation is reporting it earned in another country. The formula works by using the following common sense intuition, that in general, you should earn a reasonable amount of profits based on how much you've invested in the foreign corporation. So if you invest $1 million abroad, GILTI thinks, well, you should get a 10% return at least, so you should earn $100,000. So if you earn $100,000 in a jurisdiction in which you've invested $1 million, from the perspective of the federal corporate tax, that $100,000 was earned abroad and it is not subject to U.S. taxation. On the other hand, if you invested $1 million abroad and you earned $10 billion in that controlled foreign corporation, then GILTI says, what is going on here? How can that be possible? And the answer is, well, you spent the $1 million to buy a PO box and a couple of lawyers, and they're sitting there and they own all the intellectual property of your company. And you're basically having, say, your US operations pay very high royalty payments to your foreign subsidiary so that your US operations look like they're not earning very much money because all the royalties are taking the profits out. And your foreign subsidiary is earning a gazillion% profit. And this is a real scenario. And so GILTI says, look, if you have a controlled foreign corporation that has this skewed ratio of income to assets, all of the income over the initial 10% return is GILTI, is presumed to have been earned someplace else, and will be brought back in to the US tax base. And at that point, you can argue about exactly what happens. One way of thinking about it is half of that income is taken back to the US tax base and taxed at the regular rate. Or you can say all of that income is taken back into the US tax base and taxed at half the rate. Either way, that's the basic mechanics of GILTI. There's obviously a lot of other moving pieces, but that's the basic idea and the basic common sense intuition behind it.
So can you clarify, is this a tax on foreign or domestic income? And what was the context of the federal government starting to tax GILTI?
Terrific. So formally, the law applies. GILTI is the income of a controlled foreign corporation. So by definition, it has to be income that is formally earned abroad. On the other hand, the whole point of GILTI, the whole point of this formula, is that it's identifying income that is nominally earned abroad, but we have good reason to believe was not really earned abroad, that it was really earned domestically. So to that extent, it's a good question. It's a tricky question, right? Formally foreign, but we have good reason to believe it's domestic. In terms of the context, the broadest context is that no one likes paying taxes. Multinational corporations, no different. And the main thing that has happened for various reasons that we could talk about, though they are really boring. Multinational corporations have, since the 90s, gotten better and better and better not paying taxes, specifically through shifting profits earned in higher tax countries like the US or Germany or France, and putting them in lower tax countries, like Ireland, let's say. And not to pick on Ireland, a lot of countries. So then, and that's just been, it's just a large trend that's been going on for decades. Then the question was sort of the more immediate context of the Tax Cut and Jobs Act were two issues. One was that under the arcane Senate rules in which the Tax Cut and Jobs Act was going to be passed, the reconciliation rules, the bill could only cost so much money. And so insofar as a big corporate tax cut and other things were absolutely had to happen as part of the bill, the question was what little things could be done to raise enough money to get under the 10-year window, that the estimate of the bill. So they were looking for things. GILTI, at least its basic idea, was an off-the-shelf idea. It was like a smart economist from Treasury had, for instance, had written papers about similar kinds of taxes as well as other people. The other reason to have GILTI in the Tax Cut and Jobs Act was that it also fundamentally changed the way the federal government taxed multinational corporations. So up until 2017, the federal government said to, say, a big multinational corporation, again, I'll just use Apple as an example, again, not to pick on Apple, but Apple obviously earns money all over the world. And the US position was, Apple, we're going to tax you on your worldwide income. However, and this is relevant also for setting up our repatriation discussion, as to the income you earn abroad, for the most part, we will only make you pay taxes on the income you earn abroad when you repatriate it. So when you essentially mail a check back to yourself, which obviously a system like that encourages big corporations, right, never to mail that check back, right? So that was one big problem. But also the new system that we've started in 2018 after the Tax Cut and Jobs Act was passed is we are now officially not even going to try to tax the income of a multinational abroad. We will only ever tax the income earned in the United States. So what that means is that going forward, a big multinational corporation has even more incentive to get income out of the US, because now it'll never be taxed. You never even have to worry about the repatriation part. So it was understood that GILTI was a response not only to this long-standing problem of an increase in corporate tax avoidance, but also the reasonable likelihood, though obviously all these things are fraught and the empirical evidence cuts different directions, but the reasonable surmise that changing the federal corporate tax system to only tax on a territorial basis was probably going to increase the amount of corporate tax shifting if we didn't try to do anything to stop it. And that's what GILTI and some other provisions are about.
That's really helpful. So in your work, you argue that states can and should conform to the federal taxation of GILTI. Can you walk us through your reasons for this?
Sure. So about 44 states have corporate income taxes. For the most part, they basically say, give us the number from your corporate tax return and tell us what a reasonable slice of it was earned in the state by formula, and we're going to tax that. So state corporate taxes already piggyback on the corporate tax. And so to the extent that multinational corporations have been shifting income out of the federal corporate tax base and shifted it abroad, they were also shifting that income out of the state tax bases as well. And to the extent that the federal government is broadening its tax base, essentially to protect it, to broaden it, there's no reason for states not to broaden their tax base as well. I mean, some of those profits that were shifted to these low tax jurisdictions were earned in the US, and a certain slice of them were earned in Nebraska. And there's no reason for a state not to protect its corporate tax base. And in fact, state corporate tax bases, like the federal corporate tax base, has been in decline, right, as corporate tax avoidance has been shifted. So from my perspective, it's really just a no-brainer. Of course, if you can broaden your tax base to include stuff that always should have been there. And you can do it just by conforming to the feds, right? Not by reinventing the wheel. You should do it.
Great. So Nebraska is a single sales factor state. And so as you know, that means that corporations are taxed solely on the share of their nationwide sales that occur in Nebraska. With this in mind, would corporations have any reason to move if Nebraska continued to tax GILTI, or would their Nebraska tax burden stay the same regardless of their physical location?
Terrific. So this is a really important question. And I should say that I have presented, various of my scintillating corporate tax papers to law professors who don't like them very much either. And they often are confused about this very same point, right? So in the context of personal income taxes, in general, right, you pay tax to the state where you live. And so people are like, oh my gosh, if you increase corporate taxes, the corporations will leave because there's some idea that only corporations headquartered in a state or somehow domiciled there are going to have to pay corporate taxes, are currently paying corporate taxes. So the most important thing to understand is, right, that is not true. And it hasn't been true for a really long time. So the corporations that have to pay taxes in a state are typically corporations that make more than a certain amount of sales into a state. And so the Nebraska's corporate income tax does not tax just Nebraska corporations. It taxes all corporations who make a certain amount of sales into Nebraska. And it taxes them, remember, at like, I think about a 7% rate, and only the slice of that income of those sales in Nebraska. So it's a really, really small number. And if you assume those sales are profitable, or why would the corporation be making them, right? Why would you stop making a sale in order to avoid, at most, right, paying a 7% tax, right? It's not sensible. Now, on top of that, you raise a really important point about single sales factor. So single sales factor relates to the formula states use to decide where income is earned. And so historically, a lot of states used a formula that in part used, for example, property. And so if part of the way you figured out where a big corporation earned income is property, then at least in theory, the corporation could say, I'm not going to sell my property in Nebraska. Now less income will be apportioned to Nebraska. I can reduce my Nebraska taxes. That was always a pretty dubious argument, right? Again, because that would basically mean you had some reason to bring in Nebraska, right? Some business reason. And in order to, reduce this 7% tax, which is already apportioned to only 0.5% given the size of Nebraska's GDP to the country, to Nebraska, you're not going to do this, have this, this profitable office or factory or warehouse, right? That was always not a great argument. But now we don't care about property at all. All your property can be in Nebraska. Doesn't matter. The only thing we care about is the ratio of your sales in Nebraska to your sales nationally. And so there's truly no difference unless you're going to reduce making sales in Nebraska. And why would you if you're making money on them? If Nebraska raises its rate or and even more importantly broadens its base to GILTI, it shouldn't have any impact at all. And right, Nebraska has been conforming to GILTI, and manifestly the sky hasn't fallen. And so you don't have to take my word on it. It's actually true.
So picking on Apple again, for example, right? They're not headquartered in Nebraska, but they presumably would be paying this tax, right?
Presumably they're selling a substantial amount of stuff into Nebraska such that Nebraska has nexus with them. And then Nebraska could say, okay, Apple, tell us what your profits are in the US and apportion by sales, whatever it's going to be, 0.5% to Nebraska. And we're going to apply our 7% tax rate to that. But notice, right, we ask Apple, and again, not picking on Apple, not suggesting that it's necessarily doing any of these things, but we're asking Apple, how much are you telling the federal government you earned in the US, right? That's basically the starting point. So to the extent that some company has suppressed that number because they've actually shifted lots of their profits abroad, then the number you're going to start with is going to be artificially low. And all GILTI says is, well, we know the number is broader than that. The feds already have a way of figuring out at least a little bit. Again, GILTI is a formula. It was passed very quickly. It has all sorts of flaws, but it's not a crazy formula. And certainly for the purposes of taxation, it is close enough, and it's the tool at hand.
Great. So I want to shift gears a little bit. The Nebraska Legislature is also considering in this same bill a cut to the top corporate tax rate in the state to bring it in line with the top individual income tax rate. Is there any logic behind having rate parity between our individual and corporate tax rates?
I find that one to be a head scratcher. I mean, on the one hand, it is a good thing. It is sort of, tax policy 101 to have your rates be the same across different ways of earning money, so the tax system doesn't create perverse incentives, right? So the classic example is you can earn money as a partnership, or you can earn money as a corporation. Partnerships, or they're called pass-through entities, don't pay tax at the entity level, so you'd only be taxed as an individual. Then corporations are taxed themselves, and then also when they issue a dividend. And so that is seen as a problem, right? Because it's the taxes, because you might want to be a corporation, but now the tax code is putting pressure on you not to be a corporation, and that doesn't make a lot of sense, right? The tax code should be neutral between forms of organization. But it's really not clear, why reducing the highest corporate tax rate to the personal income tax rate is going to achieve that. And also sort of more fundamentally, the amount of distortion created by these taxes at the state level, given the rates of tax and the apportionment of income to Nebraska, are so low, so that all these ideas of incentive effects, like, oh, well, now that the rates are the same, now I can do what I want. I mean, that's really a federal level concern, right? The ability of states to influence this. And then the idea that you should lower the corporate rate to the lowest individual rate, I guess, because the assumption is maybe corporations never issue dividends, and so all that money is just taxed at the same rate as income. I mean, you can come up with a Baroque enough series of suppositions that maybe makes that true, but it seems to me implausible in terms of having any real policy impact, and is just a not very good reason to cut the corporate tax rate, which I don't think is a good idea.
Yeah, and the systems are just so different, right?
Yeah.
So can you talk briefly about the relationship between migration and corporate tax rates, particularly in a single sales factor state like Nebraska?
Sure. So this we touched upon this before, that again, there's a sense of, look, if taxes are too high, they'll talk about people will leave. There are essentially two sets of literature, I should say, about migration at the individual level. There's a whole bunch of stuff where certain prominent people like Elon Musk make a big fuss about leaving. Then there are certain not very rigorous studies that purport to show, oh yeah, you increase taxes a little bit and boom, everybody leaves. So there's that discussion in the media and the public space. Then there's the academic discussion where you actually carefully try to figure out whether people are leaving, right? Because for instance, wealthier people are pretty mobile. They have reasons to go anyway to different places. And so if you're going to do a really careful study, you need to actually control for that. And so when people do studies like that, they show relatively little individual migration. So it's important that we understand that even before we get to talk about businesses and business migration, that the baseline for individuals is itself not very great. now we get to businesses. As we talked about, state corporate taxes like Nebraska's are based on how much economic activity you have in the state, primarily, based on sales. So moving from the state has no impact whatsoever on your corporate taxes. So, that's not to say that a state can't give you more tax breaks to pay even less corporate taxes. So obviously, and states do that all the time, and for the most part foolishly. But the basic contention that increasing the corporate tax rate will in some way create incentive to leave the state, or reducing it will keep incentive to keep businesses in the state, or the same for GILTI repatriation, right? The factual predicate of that is just not true.
Great, thank you. Just one final question. Anything else that you think is important that we didn't touch on, or any advice you would have for the Nebraska Legislature as to how to treat these tax issues?
I guess I'd say this. I mean, the states in general, in the Federation of the United States, are in a tricky position. There are lots of things that the theory of federalism and other federations do that would be different. So, for instance, states carry a lot of the burden of paying for social services, especially in downturns, that many people would think would be better carried by the central government. So states really have a lot more responsibilities than many other subnational bodies and other federations, and more than theory would suggest they really should. And they do have substantial taxing powers, but I think, and the legislature seems to be very aware of this, they are hemmed in by competition with other states. And so there is this real problem. On the other hand, just cutting taxes to zero is not good for competition, because in many ways, even more important than the tax rates are the package of services you offer people, and those require taxes. And so the great art of this is to come up with an attractive set of services at a tax price that is reasonable. I don't think worrying too much about whether your tax rate is 0.5% more or less than your neighbors is going to be relevant. If you're worried about a business setting up shop in your state, they need educated workers, right? These things matter much more than these small differences. And vis-a-vis the corporate tax, it feels like, because it's a business tax, this is a useful lever in terms of spurring economic activity, but it's actually not. It has very little impact. It's a relatively low tax. It's not designed to really go up or down based on economic activity in the state. And to the extent that we're entering into a world, or have entered into a world for a long time, where certain corporations in particular are extremely profitable, and often kind of at the expense of local businesses that are now no longer paying taxes because they've been run out of business by these giants. Finding a fair, reasonable way to tax those businesses in order to maintain an attractive set of services is, I think, the way to go. And so broadening to GILTI, right? Just for example, something the federal government is making easy administratively, it protects your tax base, it's only taxing these big profitable businesses, should really be a layup.
Well, great. Thank you so much for taking time with us today and helping explain these really technical issues, very wonky, very helpful to the discussion. So Dr. Shanske, thank you so much for being with us. We really appreciate it.
You're welcome. My pleasure, and good luck.
Thank you.